1 year of investing. Marcus had $14,000 across his Roth IRA, 401k, and emergency fund. The account balance felt small for the effort he'd put in. He'd contributed consistently, resisted the urge to sell during a volatile quarter, automated every transfer, and yet $14,000. It felt like he was building a skyscraper one brick at a time with no end in sight. He called Julian.
I asked Julian, when does it start to feel like something? He laughed, not dismissively, just knowingly. He said, "You're at the beginning of a hockey stick graph. The first few years look like a flat line, then the curve bends. You can't see the bend from where you are right now, but I promise you the bend is coming. And when it arrives, it's going to feel like nothing you've experienced financially."
Compound interest, you earn returns not just on your original investment, but on every previous return. In year 1, $10,000 earning 8% becomes $10,800. In year 2, $10,800 earning 8% becomes $11,664. The extra $64, that's compound interest, not on your original $10,000, on the $800 gain from year 1. Small now. Enormous over decades. Einstein allegedly called it the eighth wonder of the world. Whether he said it or not, the math is correct.
The rule of 72, divide 72 by your annual return rate to approximate how many years it takes your money to double. At 8% annual return, 72 divided by 8 equals 9. Your money doubles every 9 years at 8%. $10,000 at age 25 becomes $20,000 at 34, $40,000 at 43, $80,000 at 52, $160,000 at 61, $320,000 at 70. The same $10,000 invested once, never touched, never added to becomes $320,000 in 45 years.
The number that broke my brain. If I invested $5,000 per year starting at age 25 for only 10 years, then stopped completely and never invested another dollar, I'd end up with more at retirement than someone who invested $5,000 per year starting at age 35 and never stopped, investing for 30 years straight. The early investor contributes $50,000 total. The late investor contributes $150,000 total. And the early investor still wins.
The math behind that: early investor contributes $50,000 between ages 25 and 34, then lets it grow for 31 more years at 8%. Final balance at 65, approximately $787,000. Late investor contributes $5,000 per year from ages 35 to 65, $150,000 total contributions, but starts 30 years later. Final balance at 65, approximately $566,000, $3 times the contribution, a smaller result. That's the cost of 1 decade.
The 10-year head start is worth more than tripling your contribution rate. This is not intuitive. Humans understand addition, more money equals more money. We don't intuitively feel multiplication operating over decades. Compound interest is multiplication across time, not addition. The base grows. The percentage applies to the growing base. The absolute dollar gains in the later years dwarf the early years, which is exactly why starting early is irreplaceable.
Julian had me project my own numbers. At my current $400 per month across Roth IRA and 401k, assuming 8% average annual return, in 10 years my balance would be approximately $73,000. $20 years, $237,000. $30 years, $600,000. $40 years, $1.4 million. The same $400 per month. The same 8%. Just time doing its work. The number at 40 years was almost incomprehensible from where I was sitting.
The threat to those projections: inflation, the silent tax. Inflation is the gradual increase in the price of goods and services over time, which means the purchasing power of a dollar decreases. The historical average inflation rate in the United States is approximately 3% per year. If your investment portfolio grows at 8% but inflation runs at 3%, your real return, the actual increase in purchasing power, is approximately 5%.
Inflation's impact on cash: $10,000 sitting in a checking account earning 0 interest loses approximately 30% of its purchasing power over 10 years at 3% inflation. By year 10, your $10,000 buys what $7,000 bought at the start. This is why leaving money in cash long-term is not safe. It is a guaranteed, slow loss. Investing isn't risky relative to cash. Not investing, in real terms, is the riskier choice.
The investments that historically beat inflation: stocks, real estate, commodities, and Treasury inflation-protected securities, TIPS. Bonds at current yields barely outpace inflation in nominal terms and sometimes lose to it in real terms. Cash loses to inflation consistently. Understanding inflation transforms the investment question from should I take risk to what risk do I need to take to preserve purchasing power. The risk of not investing is real.
Elena's question, what about bonds? Everyone talks about stocks and bonds, but I don't understand what a bond actually is. Julian said, a bond is a loan. When you buy a bond, you're lending money to a government or corporation. They pay you interest, called the coupon, for a fixed period. At the end, they return your principal. Predictable income. Lower risk than stocks. Lower return than stocks.
Types of bonds. U.S. Treasury bonds backed by the full faith and credit of the U.S. government, considered the safest investment in the world. Municipal bonds issued by state and local governments, often tax-exempt. Corporate bonds issued by companies, higher yield than treasuries, higher default risk. High-yield or junk bonds from companies with lower credit ratings, significantly higher yield and risk.
The relationship between bond prices and interest rates is inverse and important to understand. When interest rates rise, bond prices fall. When rates fall, bond prices rise. If you own a bond paying 3% interest and rates rise to 5%, your bond is less attractive. Who wants 3% when new bonds pay 5%? Its price drops in the market. This is why rising rate environments hurt bond portfolios. And 2022 was one of the worst years for bonds in modern history.
Why hold bonds at all? In most market crashes, stocks fall sharply while high-quality bonds hold their value or rise. The 2008 financial crisis, U.S. stocks fell over 50%. Long-term Treasury bonds gained approximately 26%. Bonds provide a ballast, a stabilizing weight that reduces portfolio volatility and gives investors something to rebalance from when stocks crash. For those who can't stomach large drawdowns, bonds are the tool.
Asset allocation, the percentage of your portfolio in stocks versus bonds versus other assets. Julian's simplified rule, subtract your age from 110. The result is your stock allocation. At 26, I'd hold 84% stocks, 16% bonds. At 40, 70% stocks, 30% bonds. At 60, 50% stocks, 50% bonds. As you age, you shift towards stability because you have less time to recover from a major market crash.
Modern portfolio theory and target date funds have complicated the simple age formula. At younger ages, some advisors advocate 100% stock allocation. The time horizon is so long that even a 50% crash is recoverable and shouldn't change the strategy. The key question: what allocation can you actually hold through a 40% portfolio decline without selling in panic? A theoretically optimal allocation you abandon at the worst moment is worse than a conservative allocation you hold.
Dollar-cost averaging, investing a fixed amount on a regular schedule, regardless of market conditions, is the behavioral guardrail against market timing. When markets are up, you buy fewer shares. When markets are down, you buy more shares at lower prices. Over time, you accumulate more shares at better average prices than if you tried to time perfect entry points. The discipline of regular investing defeats the intelligence of market prediction.
The 2020 COVID crash. Markets fell 34% in 33 days, the fastest crash in history. Investors who sold in March 2020 locked in catastrophic losses. Investors who kept their automatic contributions running bought shares at historic lows. By August 2020, the market had fully recovered. The investors who held or better kept buying experienced the crash as a temporary paper loss. The investors who sold experienced it as a permanent financial wound.
I had lived through a market dip in my first year of investing. My $11,000 portfolio dropped to $9,400 in 6 weeks. My first instinct was to sell. I didn't because Julian had prepared me. I kept contributing. I watched the balance fall further, then stabilize, then recover. By the time it recovered, I'd bought additional shares at lower prices. My cost basis was lower than the day I started. The dip had helped me.
Sequence of returns risk. The order in which returns occur matters enormously for retirement outcomes. Two portfolios with identical average annual returns over 30 years can produce dramatically different outcomes depending on whether the bad years come early or late. Early bad years, when the portfolio is small, are manageable. Late bad years, when the portfolio is large and you're withdrawing from it, can be catastrophic. This is why conservative allocation near retirement matters.
The 4% rule, a widely used retirement withdrawal guideline. Research suggests that withdrawing 4% of your portfolio balance in the first year of retirement, then adjusting for inflation annually, historically allows a portfolio to last at least 30 years in most market scenarios. To generate $60,000 per year in retirement, you need $1.5 million at retirement, because 4% of $1.5 million is $60,000. This translates your abstract investment goal into a concrete target.
Diversification within stocks. Not just US stocks, but international stocks, developed markets like Europe and Japan, emerging markets like India, Brazil, and Vietnam. Different geographies respond differently to economic cycles. The US stock market is the best performing major market of the 20th century, but no one knew that in 1900. A globally diversified portfolio hedges against geographic concentration risk.
I-bonds, inflation-protected savings bonds issued by the U.S. Treasury, captured Elena's attention. During the 2021-2022 inflation spike, I-bonds paid over 9% interest, guaranteed, backed by the U.S. government. Maximum purchase, $10,000 per person per year. They can't lose value. They're illiquid for 1 year and carry a small penalty for early redemption within 5 years. For the emergency fund component beyond 3 months, a compelling option.
Rebalancing. As markets move, your target allocation drifts. If stocks have a great year and your target was 80% stocks, you might find yourself at 90% stocks, now overexposed to equity risk. Rebalancing means selling some of what has grown and buying more of what has lagged to restore your target allocation. It feels counterintuitive, selling winners, buying laggards. It is mechanically buying low and selling high.
2 years in, my portfolio wasn't impressing anyone at a party. But Julian showed me something. At my current contribution rate and an 8% return assumption, my retirement number, the balance needed to produce $50,000 per year by the 4% rule, was $1.25 million. I was on track to hit that by age 57. Not perfectly, not without uncertainty, but the trajectory was pointing at a specific destination for the first time.
The compound interest curve's final insight. The last decade before retirement contributes as much portfolio growth as the first 2 decades combined, if you haven't touched the principal. At $400,000 in the portfolio earning 8%, you're adding $32,000 per year in gains alone, more than Marcus's starting salary. At $800,000, $64,000 per year in gains. The portfolio eventually earns more than you contribute. That's the bend in the hockey stick.
Behavioral finance's most important finding: the average investor significantly underperforms the average fund. The fund's return, say, 8% per year, but the average investor in those same funds earns 4 to 5% because they buy after good performance and sell after bad performance. The enemy of compound interest is not market volatility. It's the investor's own behavior in response to market volatility. The return of the fund matters less than the behavior of the investor.
3 years into his investing journey, Marcus stopped checking his portfolio daily. He moved to weekly, then monthly, then quarterly. He'd learned that checking more frequently correlated with worse decisions, more opportunities to react emotionally to short-term noise. The portfolio was automated. The contributions ran. The allocation was set. The most powerful thing he could do was leave it alone and let time do its work.
Elena's insight from the compound interest conversation. The best time to start was 10 years ago. The second best time is now. And every month that passes without starting is a month of compounding you never get back. She'd heard Marcus talk about this. Then she did her own projection. Then she increased her S&P IRA contribution by $200 per month. The math had done what no amount of advice could. It had made the urgency visceral.
Marcus had started investing at 25. By the time he understood what he was doing and why truly understood it, he was 27. 2 years of contributions had become a foundation. The foundation would become a floor. The floor would become a platform. And the platform, given enough time, would become the thing that made everything else possible, the financial freedom to choose how to spend his time in the second half of his life.
Julian said once, "Compound interest doesn't care how smart you are. It doesn't care how hard you work. It only cares how long you let it run." The simplest and most humbling principle in all of finance. The best investor isn't the best analyst or the most disciplined trader. The best investor is the one who starts earliest and gets out of their own way long enough for time to do what only time can do.